Ladies and gentlemen, good day and welcome to the investor call of CIGNITI Technologies Limited to discuss the Q2 and H1 FY21 results. Today, we have with us from the management Mr. Shrikant Chakila, Chief Executive Officer, and Mr. Krishnan Venkatachari, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Mr. Snyder Albuquerque from Adfactors. Thank you, and over to you, sir.
Thanks, Lizanne. Before the call, we would like to point out that certain statements made in today's call may be forward-looking in nature, and the disclaimer to this effect has been included in the earnings presentation shared with you earlier. The investors' call may contain forward-looking statements based on the currently held beliefs and assumptions of the management of the company, which are expressed in good faith and, in their opinion, reasonable. Forward-looking statements involve known and unknown risks, uncertainties, and other factors which may cause the actual results, financial condition, performance, or achievements of the company or industry results to differ materially from the results, financial condition, performance, or achievements expressed or implied by such forward-looking statements. The risks and uncertainties relating to these statements include, but are not limited to, risks of expansion plans, benefits from fluctuations in our earnings, our ability to manage growth and implement strategies, competition in our business, including those factors which may affect our cost advantage, wage increase in India, our ability to attract and retain highly skilled professionals, and our ability to win new contracts, changes in technologies, availability of financing, our ability to successfully compete and integrate our expansion plans, liabilities, political instability, and general economic conditions affecting our industry. Unless otherwise indicated, the information contained herein primarily indicative and is based on management information, current plans, and estimates. Yes, over to you, Shrikant, sir. Thank you.
Thank you, Snyder. Good afternoon, everyone. Thank you for joining the investor con call of CIGNITI Technologies for the quarter ending September 2020. I hope all of you are safe and healthy as we continue to live in COVID normalized times, and there are opportunities arising from surprising corners and trends not following the norms. So in the previous calls, I mentioned that about our exposure to the travel and hospitality industry. For CIGNITI during the beginning of the year, financial year, exposure to travel and hospitality was around 27% of our revenues, and it caused unpredictability in revenues, obviously, of course, due to the pandemic. Although we continue to hold fort with our existing client base in the travel and hospitality industry, the road to recovery in this industry unfortunately seems to be long, and with second lockdowns in some countries and the pandemic sort of again rising its hood, the trends for travel and hospitality industry seem to be weak at this point, at least for one more year or 18 months, in my opinion. So the cost reduction has been a prime focus for the travel and hospitality industry. Some of them that we are dealing with, that is coming out straight, and that is evident in the pricing pressure trends that we see in some of the accounts and related industries. But having said that, there are growth opportunities in the sense that there's a lot of opportunity for vendor consolidation in travel and hospitality, and we are aggressively pursuing all these opportunities. We continue to hold fort, no doubt about it. We are not letting go any of the revenues in this particular industry. But the trend as of now seems to be weak. But having said that, we have consciously and continuously worked on replacing the TTH revenue with other verticals such as BFSI and healthcare, and some of our efforts that we started putting in March, April started coming to fruition. In fact, travel and hospitality is no longer the highest exposure for us. Obviously, the revenues have come down, but we have consciously put efforts to increase revenues in areas such as banking, insurance, and healthcare. And some of those efforts have come to fruition. We have been able to add good logos in medical devices, in healthcare, and also expanded in our revenues in the existing client base, such as utilities, retail, and insurance and banking. In fact, banking and insurance is now the highest, share of the revenue pie for us, coming close to 19.5%. And with some of the existing clients renewing multi-million-dollar SOWs for multiple years. So we continue to put conscious efforts in banking, insurance, healthcare, and 5G. 5G is something that I stated last time, so we are putting efforts there as well. Excuse me. In terms of building capabilities, in terms of hiring new talent, and in terms of marketing efforts. So, like I mentioned today, our banking and insurance exposure and growth, of course, is higher than the travel and hospitality industry. In terms of billing headcount, we have almost reached pre-COVID billing headcount. We would have possibly crossed it also as well as of today. But which is an encouraging trend. Although clients are now okay to move the billing offshore as work from home has made boundaries invisible. So this is quite evident in some of the margin improvement that you would have seen. And also alongside the travel costs coming down significantly. Going by the current trend, we anticipate revenues also to reach pre-COVID levels. Although the billing headcount has reached pre-COVID levels because some of the work moved offshore, the revenue is still not at pre-COVID levels. But we anticipate, with the current momentum, to possibly reach the pre-COVID levels by the end of the year. And also, the revenue by then would have significantly improved. I mean, the quality of the revenue, because of the reduced dependency on cyclical industries such as travel and hospitality. We also seen improvement in utilization, both on-site and offshore, as compared to last quarter. We are obviously thankful to our employees who have adopted to these times and have ensured high customer satisfaction levels, despite not being able to engage in the manner they were used to. And due to this, we have now restored the previous level of pay scale, and we have removed the 5% pay cut that was implemented at the beginning of the financial year. And our overall attrition levels also are at about 15%, and we are continuously trying to enhance our employee experience, even though all of us are working remotely. Again, we are continuing to monitor various risks such as immigration policies, and we are consciously taking measures to not disrupt or impact client experience. Excuse me. Also, continuing from the updates in the previous con call, we continue to put efforts to expand adjacencies relevant to quality engineering, and we have forged partnerships in areas such as mobile cloud, RPA, application development management, and so on. And some of the encouraging trend again here is that we have already landed some accounts in this space, and we are confident of building momentum on this front as we move along in the year by making some leadership hires, by adding on capabilities, and we will continuously provide updates on this. Coming to specifics, in the current quarter, we have achieved about 3.5% growth in terms of dollar revenue and about 1.6% in terms of rupees at about INR 221.2 crores versus 218.4 in the previous quarter. And EBITDA, we have touched about 19.9, close to 20% versus 16.5 in the previous quarter. And we have serviced a total of 208 clients and added new clients in the utilities, pharma, healthcare, and insurance space. These are the updates from my side. I will now hand over to Krishnan to talk on financials and other related matters. I'm happy to answer questions once Krishnan finishes his update. Thank you.
Thank you, Srikanth. Good afternoon, ladies and gentlemen. It's been a pretty decent quarter for us. Once again, though we are not in the business of providing any guidance, but I think we are pretty confident with the onset of pandemic where the panic was quite high. But I think at that point of time when we took a call, we were very clear that we estimated that we should be plus or minus 2% with the last year's set of numbers in terms of the revenue and of course much ahead on profitability. I think we are beating the budget expectations in terms of what we are trying to do, and we have moved around from Q1 levels to the Q2 levels in terms of a good set of growth with a lot of traction and excellent project pipeline and the visibility. While the revenues have clawed back to the 30 million, but I see the next quarter also coming up very well, as Srikanth mentioned, that our number of billable resources have come back to the pre-COVID levels and it is now marching ahead. So that is the confidence at which it is moving for the quarter. This quarter has been phenomenal in terms of where we were able to gain a comfortable goodwill in terms of retaining the set of people and then redeploying them back with a 5% cut for the past 6 months, but that has been reversed out from October. That speaks volume in terms of the commitment from the company and also commitment from the employees and commitment to the client, which has helped us to serve and retain the clients systematically. The shift has been about close to 2% plus in terms of shifting from on-site to offshore, which is a welcome move invariably, while the top line could take a shave in terms of the revenue, but I think we are consolidating in this pandemic in terms of more of offshore business, which speaks very clearly an end-to-end solution involves more of offshore, and we are able to gain a better margin in offshore. That is what is also reflected in the EBITDA margin, touching north of 19%, which is close to about, to be very precise, at about 19.99. And yes, definitely there will be questions in terms of sustainability, but we are very confident that we should be able to sustain this at about 19% plus and then start moving up in the years to come. As it comes to the account, the top 20 has been an encouraging trend for us, that where we were at about close to 49% has moved up to 50% in terms of contribution and continue to remain. And while there could be an interchange in terms of the top 20 accounts, but I think our top 20 has remained stagnant over the last 6 quarters in terms of the fantastic set of numbers coming through. And we have now checked out the real strategies in terms of the going ahead for reminding and expansion of other offerings into these top 20 accounts, while the balance accounts also continue to contribute in a big way. And the churn rate over the quarters have come down and it's hovering around close to about 67%, which is a healthy trend. In terms of the billing rates and utilization, as Srikanth mentioned very clearly, the utilization has come back at on-site at about 95%, which is back to the pre-COVID levels, and at about 77% to offshore, but we expect that to improve a bit more, but I think we need to consider the various ifs and buts factors which is hovering around. My billing rate has plowed back to about $69, about 90 cents realization more comparing to last quarter, and at a flattish level at about $21 in the offshore methodology. And as I mentioned, the consolidation has been pretty good in the top 20. And while the travel sector, which was at a point of time when we started the year at about 27, 28, is now hovering around 18. But I think we have been compensating a bit where retail and VFSI have contributed a lot, and healthcare has contributed a lot. And we expect to get a visibility in terms of moving forward. We have more or less remained our contributions also come on account of cost reduction and cost optimization. And there has been a good amount of cash flow generations, which is a very important and well-becoming factor basically. Post-tax applications, the operations yielded about 94 crores for the first 6 months, with a post-tax application of about close to 9 crores. We are there at about close to 85 crores of cash realization for the first 6 months. And if I compare that with the previous years, where slides are available with you all in terms of where we are, what we are into the previous quarters, I think the last full year saw us a generation of about close to 80 crores, whereas the last a comparable last 6 months generated about 45 crores. So we are in a very healthy wicket in terms of the cash flow generation, which means that we have we expect about netting off all the working capitals, which is just a mirage in terms of using for the purpose of limits for on the last day of the month or whatever it is. If I push that out probably in 2 quarters put together, we expect about 200 crore plus as a net cash available on hand by March or so, the way the business is ramping up, which gives us enough power for us an engine to fire through in terms of investing back or distributions or whatever it is in terms of the decision making. I think we are on a right path, and we expect the visibility is great, and we expect to move forward in a galloping nature. And with these few words, and I would like to thank once again for your patient hearing, and I would like to open up the forum for question and answers, which me and Srikanth can take it up. Yeah.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, if you wish to ask a question, you may please press star and 1. The first question is on the line of Nirmal Bari from Sameeksha Capital. Please go ahead.
Yes, sir. Thanks for the opportunity. I was going through your deck, and I missed out on the on-site offshore employee count and how that has been shaping up. And secondly, if there would be an impact on that, given the second wave that is coming up in Europe and US.
Yeah. Srikanth, I'll take this question. In terms of the second wave, probably, yeah, I will not delve deep into it because in some of the cases it is more of a precautionary lockdowns which is coming through. And then I think we are there with the COVID to stay, and invariably we have learned the hard way and over the last 6 months in terms of how do we really move forward in terms of the pandemic. If you look at the offshore on-site as a combination, basically comparing to the previous quarters, basically from average resource count will be the right measure, basically in terms of availability. From 530, we have come down to 499, or so, about close to 8%, 7% down in on-site, whereas in offshore we have moved up from 1,500 to about 1,625. So that is what I said, that in the overall yield in terms of the people and revenue mix is at about a 2% shift comparing to what it is in the previous quarter, so which is moved out and given a shift in favor of the offshore, contributing to the margin.
Okay. My second question is on the same lines. So now that work from home is becoming a relatively more acceptable proposition, do we expect this testing to also move offshore, as in the customer's acceptability of offshore testing increasing or something?
Yeah. Okay. Yeah. Currently,
we are already seeing this trend. Yeah, Krishnan, go ahead. Yeah.
Yeah, I'll just give only statistics, Srikanth, then you can supplement it. Currently, if you look at it as our trend, we have in terms of resource mixes at about 76% offshore and 24% on-site. So this directly answers the question that in terms of acceptability of the customer in terms of work from home as a culture, and preferably more so whatever location it is, and more predominantly offshore because it saves a lot of cost across the globe. Srikanth, you may add up a point. Yeah.
No, offshore acceptability has always been there. In the world of Agile and DevOps, we were seeing a trend that co-location was becoming important, which is also there at this point in time. But right now, wherever costs are becoming important and productivity is not taking a hit, clients are absolutely fine with offshoring. This has always been there. It is nothing new.
Okay. My third question is on the cloud adoption. Since COVID, the cloud adoption proportion has increased significantly specifically for retail and some of these other segments which were earlier. That is what we are listening from all the IT companies. So in an era where everything moves to cloud, how does the opportunity for testing change for us in terms of quantum as well as in terms of the quality of work that we would be doing?
So it will change in the same proportion it is growing, meaning whatever cloud adoption is happening. So if, for example, if somebody wants to move from Microsoft Cloud to Amazon Cloud, you would have to test for the functionality being the same, irrespective of moving from whatever cloud to whatever cloud. So the testing would grow proportionally. So there is the opportunity for growth is directly proportional to the growth in the cloud era, and we are witnessing it. Some of the banking customers that we have who are going all digital, we have been helping them ground up in terms of their ability to move to cloud seamlessly.
Okay. My question was actually more from the perspective of clients who would be having their systems on-premise moving to cloud. So an on-premise system, if I am not wrong, would have an app or whatever tested first and then implemented. But in a cloud, the go live happens much faster, and there are multiple iterations of the same app or coming up with minor changes and all. So does that make a difference in the way in our business or no?
I did not understand your question fully, but my understanding is that the adoption of cloud on-prem or otherwise is an opportunity for companies like CIGNITI, and we are seeing growth. But I have not been able to frame your question fully. So if you want to reframe it, I will be able to help.
Yeah, so I'll try to reframe it. If the opportunity for testing for an on-premise system was say ₹100, what would it be when the system moves from on-premise to cloud? This 100 is on an ongoing basis. If the opportunity was 100, what would be on the cloud?
Okay, so this is totally dependent on the scale of the application. So if the scale is huge, then going to a private cloud will be very expensive versus going to on-prem will be lower. That helps. I mean, it depends on the application totally. The question has to be slightly more specific in my opinion. But we help clients in such situations where they want to decide between moving to on-prem or otherwise in terms of how seamlessly it can be done and how quality engineering can help them achieve it seamlessly, and that is an opportunity for CIGNITI in terms of improving its revenue, improving its digital revenue, and being new age.
Okay. And my last question was on the DSO movement. So we have had quite significant collection of receivables in the first half. So how sustainable is the current DSO level?
It is sustainable. In fact,
it's a
behind this, and it is sustainable.
Okay.
In fact, the encouraging part is that even in the pandemic, comparing to the first month to the subsequent months, I think there has been a tremendous set of collections which is flowing across, and we have not seen any kind of hampering. And that goes to say also is that the quality of clients whom we deal with and the kind of services what we do. So we're not seeing any hiccups at all, and we expect this to continue. Yeah.
And with this government incentives that many of these clients were enjoying coming to an end in the previous month or in the current month, that will not have any impact on the DSOs, right?
We have been very transparent in adding up a slide in terms of what is the kind of incentives which we have been receiving. We have not been receiving, which is the 90% of the revenue yields from USA, and we have not been receiving any single.
Krishnan, his question is with this.
Yeah, I understand he's linking into DSO comparing to the incentives which is coming through very clearly. I'm coming there basically. So from my perspective also is that my incentive which is accounted for very clearly is that very minuscule in the third world countries other than US. And if you look at predominantly the corporations which has been claiming out over there also, in terms of the net worth cap is available in terms of for what they claim. So most of these companies where I deal with do not get qualified out in terms of the various incentives which has been putting it out basically based on the net worth and other caps which you see the fine prints of the policies. So we have been very carefully tracking it out very clearly, and we don't see any imminent threat in terms of the receivable issues. We keep to hover it around currently, which is at about 57, 58 days. Plus or minus 5 days this way. That way, I think we should be there around. So that shouldn't be an issue.
Okay. Just to supplement to Krishnan, we also do credit checks wherever possible to try and ensure the collectability is not affected, and also have insurance mechanism in case things go south.
Okay. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
So just wanted to understand your comment over the growth outlook over the medium term maybe. So any comment would be helpful. Thank you. That's it.
Yeah, Shrikant, would you like to take it?
Sorry, you want a growth outlook, you said?
Yeah, over the medium term, what sort of do we see in terms of the pipeline and what we are seeing?
Okay, so pipeline, of course, I can give you a broad outline that we have been. So growth outlook in terms of specific industries, I think we are seeing a lot of.
Overall, I'm talking in terms of overall, in terms of our top line. Yeah.
Okay, that part guidance I cannot give, but we hope that we will achieve last year, close to last year revenues towards the end of the year.
And over the medium term, so I was not looking for this year, over the medium term. So.
Okay, so we, of course, we have, based on some of the 3 to 5 year plans that we have set up for ourselves, we have made investments into a few areas such as 5G, banking and insurance and healthcare. And these industries generally tend not to be cyclical. Leave 5G, but banking, insurance and healthcare generally tend not to be cyclical. And one of the trends that we are seeing there is there's a lot of digital adoption. When I say digital adoption, in terms of where people are approaching healthcare, in terms of where people are approaching banking, there is a lot of possibility of overhaul in terms of the systems and the banking experience. So there is a lot of dollars that is being spent in terms of enhancing this experience. And because we already have a few case studies relevant to the experience that we are pursuing, I think we anticipate double-digit growth in the specific sectors that I mentioned. And if we are able to, we are hopeful that we will be able to build enough capabilities, hire the right leadership, possibly towards the end of the year to sort of ride on this growth wave. And if we do that, we will possibly be in the double-digit areas.
Fair enough. Yeah, I think thank you very much. That's from my side.
Thank you. We'll move on to the next question. That is on the line of Supratim Basu from AmeriCorp Capital. Please go ahead.
Hi. Nice set of numbers for this quarter. A couple of questions. One is that for the first time, I think I'm hearing you guys talk about 5G or telecom as a new vertical for the company. Can you talk a little bit more in terms of what you're doing or planning to do in this segment and what kind of clients you would be targeting?
So basically, we are at this point we are targeting 5G experience testing. A lot of 5G is being rolled out in the US, and there is a specific requirement from our existing clientele to test the 5G experience rollout, 5G rollout experience rather. And we are building some capabilities to measure the sentiment, positive or negative, do some network testing and things of that nature to begin with. And we have something called a growth advisory council internally, and we have sort of appointed one gentleman from the telecom space to be on that advisory council, who's helping us build this product, who's also an existing client for us, by the way. And they provide software for all the large service providers based out of the US and also Europe. So we first intend to, and we already have paper with.
Srikanth, sorry to interrupt, but I'm not clear. What does it mean when you say 5G experience rollout? I mean, if you're not working with a Verizon or a T-Mobile in the US, then what? I mean, for any other customer, what kind of experience?
So 5G, while Verizon and all they're rolling out their software, they're dependent on software from vendors outside of their own internal providers. So this company that we are working with provides the software for the companies that you're talking about, and it is through them that we are building this. In fact, we have MSAs with some of the companies that you're talking about.
So if I understand you correctly, you are essentially working with a software provider or a platform provider to somebody like Verizon.
Yes.
Okay.
And they are working with all the telecom providers, both in US, Canada, and US, Canada, and Europe. And with so much demand for the latest 5G offerings, they are under pressure to deliver this experience rollout. And because we already have MSAs, active MSAs, but no revenue from some of the larger clients, we intend to use this as a foot in the door to get into the account and expand.
So, if you can just give me a little bit more flavor in terms of what does experience rollout testing include?
I want to, but I just have to hold on to a bit.
Okay. So this is a customer that you said you onboarded last month. Is that correct?
No. This is a customer that we have for the last 2 years, but the capability building has started last about a quarter and a half ago.
Okay, got it. All right. And then on also on the BFSI and healthcare vertical, which seems to have taken up the slack from the lower revenues in the travel and hospitality sector. Could you talk a little bit in terms of new client additions, which geographies they're coming for, and what kind of work you're doing for them?
Yeah. So I think more than new client additions, we've been able to consolidate a lot of, consolidate vendors in the existing clientele that we have, especially in UK. where we had one digital banking customer with multiple vendors. We have been able to consolidate it to a single vendor, which is CIGNITI, and we've been able to sign a fairly significant size deal for the next 4 years. So that has, of course, tremendously added.
This is in the US.
This is in UK. But even in the US, in the Southeast US, we've been able to again consolidate vendors for one of a medium-sized bank, I would say, in the Southeast of US. And again, in Canada, we've added a couple of new clients.
Okay. And in health,
more than banking, it has been insurance. So banking and insurance drove that 19.2%, 19.5%.
Correct. Right. Yeah.
Not just banking alone, banking and insurance.
No, got that. Just in the healthcare side, you have one named client, which is actually two named clients, Glaxo and AstraZeneca. So is the large part of your work in the healthcare space to do with pharmaceuticals, or do you work with other service providers in the space as well?
It is a mix of medical devices and pharma, not just pharma alone. In fact, the last 6 months or so, we have added a lot more in the medical devices space, especially in the diabetes, device testing space that has picked up a lot of momentum.
Do you see significant growth, I mean, higher than company average growth coming from this segment?
We definitely see a lot of dollars being spent in this space, and new compliance rules coming up for some of these companies, and they are dependent on companies like CIGNITI to test for those compliances. And that is where we are seeing the opportunity, and that is where we are able to add this medical device testing clients.
Okay. Thank you very much.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Neerav Dalal from Maybank. Please go ahead.
Yeah, couple of questions. One is on the margin side. What do you see the outlook? The margins have shown smart improvement every quarter. That is the first question. Second question is on the healthcare side. Now, for an AstraZeneca or a Glaxo, what type of work, what type of testing would you be doing? If you could just elaborate. You said that regulations changing, but if you could just elaborate on that as well. Thank you.
Yeah, Krishna, Srikanth, I'll take it up on the margin, and then you can just chip in and talk about the offerings, what we try to do on the AstraZeneca and other side. Margin, Nirav, is that we have been laying our foundation, as I've been talking about a couple of quarters back, in terms of how do we really pull it out in terms of stabilizing the margin and moving it north. And I think a couple of things have helped basically is that we were optimistic that we should be there at about 18.5% north. It touched up about way ahead in terms of EBITDA and also the gross margin level basically. One is my optimization severely on account of this pandemic, and once this discipline is enforced in terms of where we are, what we are, and getting into the more of digital medium, I think that's going to stay out. So I don't see any reason basically, and more offshore shift coming in. Now we are trying to focus very clearly with more of an offshore business where the margins can improve, and also volume business so that the growth can accelerate out very clearly on both sides. So to answer your question in simple, I think we have made our inroads in such a way that we should be able to sustain this margin of about good gross margin and EBITDA margin as what you have indicated in these 2 quarters put together on an average basis as a sustainable one moving forward clearly.
Great. Just very quickly on this margin thing, as we see business move from on-site to offshore, on the one side we will have margin improvement, but then revenue growth for the interim quarters would be a challenge. So how do you see that move? So do you see in a couple of quarters that problem being resolved and we get back to growth? And so how should one look at that?
Yeah, I think it's a good question, and that's what I answered partially in the beginning. Is that very clearly is that this any kind of a pandemic or any kind of an event which takes place is basically a food for thought in terms of how do you really rework your business and start focusing out clearly into the what you call differential methodology very clearly. So this has given us a thought very clearly in terms of our increasing and aligning our offerings much slightly with testing and in and around testing in terms of the extended services, so that we are now trying to focus out very clearly with these clients as to, if you see at one hand, basically we have brought down the number of clients so that we are staying focused on a set of quality clients very clearly. On the other hand, basically we are trying to expand the footprint and portfolio within them in terms of the number of offerings what we try to do. So when I experiment that in these quarters very clearly, I know for the fact consciously that while offshore gives me a margin, probably it definitely cuts my revenue out in terms of the top line. So that is one of the reasons I'm trying to play a volume game. The volume game can come in terms of one, expanding the current business within them very clearly, or adding up a few lines of business, which is what Shrikant mentioned, that where we have done a lot of investments into the current set of people and also the current set of business and also to the newer technologies, so that we can start. Just as a good example, while I do my testing, probably I'll step back a bit and I'll also help them in doing a release management very clearly, coupled with testing. So these are the kind of capabilities which has been built in out very clearly, and the collaterals have been built and the capabilities have been built, and the advertisement and the marketing medium has been geared up for us to really approach. So we are conscious of the fact, and this is one of the years where basically people would like to float around in this kind of year with the plus or minus kind of a position comparing to previous year. But I think the year next basically has to really move up, for which we have laid a roadmap for the next 3 years in terms of where we should be, what it should be in terms of reasonably priced. I think we will definitely come out separately out in terms of an analyst meet and things like that as the time permits and as the pandemic permits, in terms of to move ahead to share our plans probably 2 quarters almost towards the year end or so. So we to address your question, yes, the volume growth is also being addressed very clearly, and that will see a visible effect a couple of quarters down the line very clearly.
Got that. And on the healthcare part?
Yeah, healthcare, Shrikant, would like to explain in terms of our offerings.
Yes. So generally we the healthcare and pharma companies, they have their set of applications and software where we do the functional, manual, performance testing and the general course of business. But right now there is an opportunity with some of the healthcare companies, especially with companies that have devices, to there are certain IEEE protocols such as IEEE P2721, which is a cyber security protocol that they have to adhere to, and this adherence has to be tested, and the conformance to that has to be tested by a ASBA certified company, which is an FDA rollout, and we are trying to get that certification so that we are the certification authority for their conformance. So that is something that we are working on for some of the healthcare companies that I'm talking about. And some of these are, for example, one of the clients that we work with, they have a insulin administrating device based on different things. You can administer the insulin through your mobile, through the app of your mobile, and because it is directly administering it into your body, the testing, it is a mission critical application, and you have to ensure that the cybersecurity of the application is foolproof. You have to ensure that there is no overdosage because the app is acting funnily on a different OS and things like that. So that is
I understand on the equipment side, more so to do with the pharma companies. So are there pharma industry specific softwares which they have to use, and there they need the testing from you, or is it the R&D clinical research where they use certain software?
We are only working on the IT side.
Okay, on the IT. So it would be industry specific softwares, or you have the ERPs and the softwares that they generally use where they need you?
Actually, there is nothing specific from our side in terms of offerings. It is whatever software that they use.
Okay.
We go and do our course of business. There's nothing specific really from our side.
Got that. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. The next question is from the line of Supratim Basu from Americorp Capital. Please go ahead. Mr. Basu, your line is in the talk mode.
Can you hear me?
Yes, sir. Please go ahead.
Okay. Hi, Krishnan. A couple of follow-up questions on the financial side. You mentioned that there's been a market improvement in receivable collection days compared to, let's say 4 quarters back where Cigniti was. So what kind of changes have you made to your processes which has enabled this?
Okay, fine. No, I'm just trying to give a perception in the market as that pandemic is a problem basically that which could lead to a collection default in terms of the working capital cycle issue and things like that. So for that, what we also felt anticipated and while we took our insurance cover and all, but I think that we could see some amount of collection dips in April, but I think comparing to that in May onwards, that is what I said clearly is that there has been a remarkable improvement in terms of the collections. Okay, a couple of steps which we have taken out very clearly, which I can also add up to say in terms of that. It's a very simple, vigorous follow-up which we are trying to do very clearly in terms of getting that. Wherever we have signing up for the client or where we feel that there is issues in terms of where we could see that this client could be into cash flow, I think we just go up and in 30 days time we try to say very clearly that we are upfront willing to give about 1% and we try to get the money in quickly. But I think that could be a combination of about 5 to 6% of the total volume of business what we have done over the last 6 months if you look at it clearly. So that we keep the estimated litigation and various other costs in mind, and then we try to get that out and move up invariably. And consciously and consistently, we have been bringing down the receivable because it is more to do with the type of clients in terms of the businesses, and that has been there at about where we have stabilized it at about 63 days or 64 days, and now it's come down to 57, 58. So our wishful thinking also has been that we should be there around that day. So these are the summary comments which I would say.
And you think this is sustainable on a longer term basis?
Absolutely. Absolutely. The discipline has been built in now very clearly where now we have the ERP system in place and there's an automated messages, the invoicing, everything goes on time and then the entire follow-up happens on an automated basis. And we have a heavy follow-up mechanism and we have the sales commission linked to receivables very clearly, which means that the sales guys has to be on the run invariably, and also we have the delivery manager's variable pay link. One of the KRAs being that the receivables realization in time. So definitely the sales commission at least are paid only based on the receivables realized and not on the sales made. So invariably that makes them all the more careful in terms of getting the money and especially in time. So that is what.
Right. And did you actually have any defaults for which you collected money from insurance?
Insurance is a safe play we have put. You want an exact statistics probably, I can talk out very clearly, is that about 2 crore 95 lakhs, which is in terms of rupees, sorry for using the rupee term, but then 2 crore 95 lakhs is what is the receivables which is across 90 days, which I can go and claim. And out of which 2 crore 55 lakhs have already been received as an unaccounted credit from these clients without the invoice rate, so which means that leaves me at about 40 lakhs. And when I file a claim, I need to pay about $20,000 as a fee. So that's the reason I kept that as a safety mechanism and not to go ahead and claim, because I know for sure that I can play around with 40 lakhs on a revenue which has been there at about close to 500 lakhs. So not an issue in terms of moving ahead. While I have safely provided that in the books, and then I have as a provision for bad debts, but I'm still vigorously following it up to get things.
Okay. And one final question on the taxation side, that is, you've taken a hit of around 9 crores for past taxes plus your, current taxes more or less the same tax percentage. But could you talk us through this?
Yeah, perfect. We have been under transfer pricing mechanism, as you all know very clearly, that all my end contracts are signed by the subsidiaries, and we try to do the transfer pricing mechanism from India for the services provided, which includes payroll plus infrastructure plus management and various other costs. Under the US regime, very clearly, they try to allow the transfer pricing on the payroll plus markup as one methodology, or you go with the methodology if you try to put all other costs put together in terms of all other costs plus a markup, which is a slightly reduced markup. We have always been doing that on a complete total cost plus markup very clearly. The assessments were due from 2015 once it is established in terms of transfer pricing. So 15, 16, 17 were assessed out very clearly. And while doing this assessment also, they also reviewed or scrutinized the entire income tax returns filed for 15, 16, 17, 18 calendar year, which includes 17 had, for the history of the company, we had about close to 340 crores of write-off, which had a split in terms of about close to 200 crores in US and 140 crores in India, while the Indian assessment is underway and where we are confident in terms of pushing it through fully. Even in the US, successfully we waded through, and then the entire assessments were completed with minor questionings. And
so this is a final settlement number for the US.
Yeah, absolutely. Sorry.
I said this. So this is the final settlement number for the US.
Absolutely for the transfer pricing. And then since the draft order has come, we wanted to be compliant on a corporate governance form in terms of, which just came in after the balance sheet date. But still, when we discussed with the audit committee head and ENY and said that let's move forward and take this out very clearly, because it is an event which has come after the balance sheet date, but before it is being published. So we went ahead and we took that out, and this is once for all done for the quarter.
Right. Okay, great. Thank you very much, and all the very best.
Yeah. Thank you.
Thank you. We'll move on to the next question. That is from the line of Abhishek V from Vision Capital. Please go ahead.
Hello. Yeah. Am I audible?
Yes. Very good.
Yes. Actually, you spoke that digital adaptation is going to be a good opportunity, but actually some days back there was one article about the way the companies were expecting the flow of the digital adaptation after the pandemic. So the companies are not so quick to adapt digitization because of the cost involved and even the impact or maybe the risk involved in abruptly changing to the digital the cloud based and the digital ways ahead. So what the article said was it's going to be more of a 6 to 7 years kind of opportunity rather than a next 1 or 2 years kind of opportunity. So is it the ground reality is the same, or what kind of situation you are seeing? And in that respect, what kind of guidance you want to give for next couple of years, top line, bottom line?
Okay. I'm hearing a disturbance.
Yeah, that is on the line of Mr. Abhishek.
Okay. So again, guidance we don't give, but I also don't know which article you're talking about. If you give a reference, I'll be able to look at that and be specific. But it again depends on the kind of industry that wants to adapt or go digital. For example, in the US, where I live in Dallas, in case you want to visit a doctor, you most of the time you cannot go and visit a doctor for minor things. You have to go online and do a televisit. So in that case, you are forced to go digital. I mean, they've almost gone digital overnight, and irrespective of the costs involved, they had to do it. Similarly, people going to an ATM and touching the screen, they're not preferring it. Instead, wanting to tap their phone to draw out money. Even their credit card is now a part of, even my credit card is part of my phone now, and I put that, I tap in case I want to draw cash, which of course is a rarity in the US, but in case you want to draw cash, you have to, you don't want to touch the screen in the current times. Similarly, ticketing in the US, if you go to kiosks and get a boarding card, you want to go contactless. That's the new thing that some of the airline clients want to build. So there are multiple examples of going digital where people are forced to go digital. And you are right, it is not a 1 year, 2 year journey. It is a very long journey. Some of it will need it forever. Some of it will need it for now. So it really depends on which industry that you are referring to spend their money. Some of them have to do something, but they don't have the money, so they'll have to think of innovative ways. Some of them have the money and they are forced to do it. They will do it. Hospitals and healthcare, they have no choice, so they're going digital. So it really depends on what industry. And this digital world is a very, everything is digital now. So it's very difficult to define what digital is in that sense. So people can write this way or that way.
In coming at least 2 years, that's what you can talk about, or maybe because the article specifically spoke about the excitement or enthusiasm about the deal wins, or sudden disruption had waned in a bit because it's going to be a longer term kind of opportunity. So
I don't know which article you're talking about.
Okay, but you don't see that kind of. Hello.
Yeah.
I'm so sorry, sir. We're not able to hear what you're saying because of the disturbance.
Actually, my line is clear. I can hear properly. Even I am seeing some disturbance. Okay, fine. Hello.
Yeah. So,
yeah. Yes, sir. Please go ahead.
Yeah. Trends vary from industry to industry. I cannot specifically comment unless I read what you are talking about. But when you say digital, there are multiple technologies that are involved, and some of them will grow next 2 years or 6 years or 7 years. There are huge bets that have already happened, and a huge marketing push that is happening. Because of the adoption of mobile, adoption of so many collaborative technologies, I think areas like cloud will be there to stay for a very long time.
It means, our companies is going to be beneficial, of these particular trends, right? The disruptions which are happening.
Yes, we of course want to invest in those areas and ride out the wave. Yes.
You spoke about the one deal win in the UK, right? Is it in a BFSI space? And just now, I think some time back it was you spoken about it. So what kind of So is it in a BFSI space, and are we seeing good roadways in the European countries as well, or is it only UK which we are seeing some kind of deal?
The banking deal I spoke about is from UK only, correct? But US is where we are seeing more traction than Europe. Actually, Europe we have limited presence except UK and Ireland. Europe we really don't have that sort of presence. only UK and Ireland. So UK and Ireland, we are not seeing as much growth as we are seeing in US.
Venture out in the European countries as well, or US is the place where we want to, concentrate on or focus on?
So US, of course, will continue to be our mainstay. UK is where we will, of course, we have about 12-13% of revenue coming from UK. We will possibly enhance that a little more, but US is where we are concentrating at this point in time.
Okay, thanks a lot. That's all from my side.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to Mr. Srikant Chakilam for his closing comments.
Yeah, thank you everyone for your patience, and thanks for all the questions. I will certainly keep all of you updated on the progress in the upcoming quarters, and I wish all of you to be healthy and safe, and a happy Diwali to all of you.
Yeah. Thank you.
Thank you. Ladies and gentlemen, on behalf of CIGNITI Technologies Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.